is the Arlington County Board of Equalization hearing. All 5 members are present, so we have a quorum, and there are 6 cases on the agenda. The first case, RPC 17002020, has been rescheduled for 6/24, so we'll move beyond that. The second case is RPC 23007111G. The request from Ms. Ross was received on the 5th to withdraw the case. I assume there's no objection, Ms. Roskin?
No, ma'am, there is no objection.
All right, then I'll move to accept the withdrawal. Do I have a second?
Second.
Mr. Yates is a second. All in favor? Aye. Opposed? Okay, that's unanimous. That withdrawal is accepted. Okay, so next up is the third case on the agenda, RPC 2800502A at 4990 Columbia Pike. Ms. McCraw, you can start with your 8 minutes and tell us about this property.
Thank you very much, and good morning, board. The subject property is was built in 1959. It's a Class B/C apartment building located in the Columbia Forest submarket, and it contains 227 total units. For 2025, its initial assessment was issued at $57,954,900. We did appeal this particular property administratively, and at that level, we did receive a reduction from that $57.9 million to $54.3 million. The main issue that we'd like to bring to the board's attention today is that the subject property sold for an arm's length transaction in September of 2024 for $51 million even, or approximately $224,000 per unit. It is our opinion that the assessment office did not consider this purchase price in their initial assessment or their reduced 2025 assessment at $54.3 million. It is of our opinion that the sale price, the arm's length purchase price of $51 million in September of 2024, which is well within the assessment period, is the highest evidence of fair market value. And again, it's our belief that it's the error in the county assessment that they failed to acknowledge this purchase price, which we believe must be considered for 2025. We're here today to ask the board to consider this purchase price, which is just $3 million below the current 2025 assessed value of $54.3 million. This sales price was agreed upon and negotiated in calendar year 2024, as evidenced by the enclosed fully executed purchase and sale agreement, which was dated July 31st, 2024. This agreement can be found on page 180 of the BOE memo. I believe the footnotes might have a different page number, but it's on 182 of 175 of the footnotes. This purchase and sale agreement, again, is dated as of July 31st, 2024. Additionally, also enclosed in our submission on page 174 is the fully executed closing statement as of September 26, 2024, which outlines the purchase price again of $51 million. This purchase price was completely arm's length. The buyer was under no obligation to sell. The seller was under no obligation to buy. This purchase price was agreed upon, negotiated throughout calendar year 2024, and its purchase price is well within market here. I'd also like to just point out that tax year 2024, this property's assessed value was $48.7 million. It increased nearly 20% from 2024 to 2025 at its original assessed value of $57 million. And the reduced value after the informal level of $54.3 million still represents nearly a 12% increase year over year. This increase is well above the average increase as outlined in the county's guidebook. On average, multifamily properties increase about 4.2% year over year. So the property's initial assessment and even the reduced assessment are still well above this average, especially in consideration of the arm's length purchase price in September of 24 for $51 million. So at this stage, I'm open for questions and will yield. Thank you.
Okay, thank you. Mr. Cheekas for the county, please.
Yes, ma'am. Good morning, board members. Good morning, Ms. McCraw. We'll focus primarily upon the summary sheet. I believe that's page 3 of your summary packet. We did, in fact, consider that sale that took place in August of 2024. As the board may know, per code, we do, in fact, value those income producing properties via the income approach to value. Not again, to say that we don't consider the sale price that was achieved, but again, income producing properties follow the income approach to value. I would note and stress the appraisal that was associated with the purchase has a concluded market value of $53,900,000, as you can see in column G. We display both column G and H. G directly from the appraisal. In this case, they did include real estate taxes, so we wanted the board members to make sure that they saw column H, which of course was with real estate taxes removed and the effective tax rate added back in. One of the principles of real estate, commercial real estate, is the principle of anticipation, which is essentially the idea of future benefits, values derived from future benefits. So while we do, again, believe that sale price of $51 million was achieved in an open market, at the same point, there is an expectation that that value would increase. And we do believe that based on the information we received, including, again, the fee appraisal of $53,900,000, some $400,000 less than our assessment, brings our assessment into accordance with what's been achieved. You can see the reconstructed year 2024 that we received, 6 months of the year. If one is to extrapolate that data out to the rest of the year, you can see that, again, it's very much in play with what our projections are for the year 2025. And again, follow that extrapolation just of NOI alone, and you'll see that it'll come out to a higher number than what was achieved in 2023. Again, echoing our belief that the property value went up after the data value. One can also see that when looking at the projections made by the appellant, that essentially it's just going after the sale price and ignoring the income approach to value. Thereby, we do believe that based on the data that we received, 6 months of income stream data that supports the previous income history, market value, as well as sales comparison valuations higher than the sale price that was achieved, we do believe that the county should be confirmed at a value of $54,300,600. Thank you.
Okay, thank you both. Questions from board members? Mr. Hoffman.
Yeah, I just had a question for Lib. I was trying to find the broker for the transaction in the PSA. Do you know who that was?
I actually don't know who it was off the top of my head. The client didn't get back to me on that one. But it was offered to 5 groups and they received 5 offers.
5 offers. Okay.
Yeah.
All right. Thanks.
Okay, any other questions? Mr. Yates.
I guess to the appellant, I'm just curious on the operating year 24 and the reconstruction, a 10% vacancy seems out of line. Is there a reason there? It's before the sale. The appellant?
Oh, I'm sorry, I was on mute. Yeah, well, we don't have the full year of income and expense. Obviously, this was purchased in September of 24. For the trailing couple of years of vacancy, it was about 5%. It was 5% vacant as of the date of value. It's hard to extrapolate based on only a couple months of actual income and expense.
Okay.
But from just simply annualizing it, that's the amount you get. But again, I'd like not to rely on that, just knowing that we don't have a full year of income and expense here. I think it's just rough estimation at that point.
All right. So 24 is just, okay.
Okay, any other questions? Okay, Mr. Cheekas, if you take a minute to wrap up.
Yes, ma'am. So again, as you've been known by stylists to look at the history of the property, 2022 saw a growth of 3%, 2023 saw growth of almost 8%. Again, we only have 6 months of the year for 2024, but extrapolation will show you that they're on pace to succeed the year 2023. Again, we have a free appraisal from CBRE, an industry expert, $53,900,000 market value. Talking about strengths, including over the next 5 years, rental growth of 3% on average. Units have been upgraded. Subject is 94% occupied and 95% historic occupancy or better. Subject has project amenities, including swimming pool, fitness center, and computer room. We do believe these support our revision to valuation of $54,300,600. Thank you.
Okay, thank you. Ms. McCraw, if you take a minute to wrap up, please.
Yes, thank you very much. Again, it's our opinion that this purchase price, this arm's length purchase price in September of 2024, well within the assessment period, is the best indicator of fair market value here. And again, while we don't have a full year of 2024 operating performance due to the timing of the sale, I would like to point out on page 4 with the assessor summary page that this property averaged 2.8 million NOI for the previous 3 years of income and expense that was submitted. The assessor in their pro forma is anticipating nearly a 20% year-over-year growth, which based on historical trends has not been evidenced at this property. As well as in the appraisal, they did summarize that this 51 million purchase price is well within market. And actually on page 465, the matrix analysis shows that at a 6.25% cap rate of 51 million value as well within market. So thank you very much for your consideration.
Okay, thank you both. Okay, it's just among the board. I mean, I'll start. I think that one of the last things that the appellant said about the historical information, it pretty much hits it, hits the nail right on the head there. I mean, I think it was good that the county took a look at it and reduced it, but I think it's a little aggressive where it appears to be listed at based on the performance that we see for the past 3 years. And I think the $51 million purchase price in the period does have some relevance to this assessment. Where's everybody else? Mr. Yates?
I looked at the 51 million and I looked at the little continuing growth, which the county did bring up to come up with a higher number. And I put a 3% increase over the 51 million on it. And it came up with 52,530,000, just to see where it would be with the 51 million and continuing growth into 25.
Okay, Mr. Hoffman?
Yeah, I agree with you, Mary. Especially since last year this was assessed under 49, you'd expect it to come up closer to the sale price and not like leapfrog over it. So I'd support just putting it right in there at 51 million.
Yeah, with the thought that it's probably going to go up next year, but you look at this and you think the sale was used and other properties were assessed based on the sale. So I think it's only fair to
and
this property on it. So
the contract's included in there. It's pretty straightforward. I've reviewed the contract. There's looks like there's some Fannie Mae financing on the deal, which usually yields kind of the highest price because the financing is the cheapest source of money. So I think they got a fair offer.
Mr. Mendez or Mr. Penaranda?
Yeah, I would agree with both you and Greg. Just one point, the county mentioned the appraisal being 5.3 million at the time of the sale. Appraisals can be subjective. I think the best data point there would be the actual sale in the open market, especially with 5 offers. And they're even asking to increase it more than the appraised value that they stated. So with that, I would be more inclined to be closer to that 5 to the sales price.
Okay, Mr. Penaranda?
I'm okay with it. Yeah, I think it's realistic that we make that change. This is really not a very far from using the full numbers if they were available. But looking at, like you said, the NOIs and the numbers from above, I think it's a little bit more than we probably would have seen it if there was no sales price.
Mhm.
I'm okay with it.
All right, well, with that being said, then I'm going to move to reduce the assessment to the 51 million sale price. Do I have a second? Mr. Hoffman, all in favor?
Aye.
Opposed? Okay, it is unanimous. The assessment's reduced back to the sales price of 51 million. I know, Ms. McCraw, you know that that's for this year only, and we will have information next year, and we hope the new owners are happy to pay higher taxes because I believe it's going in that direction.
Absolutely. Thank you so much.
Thank you. Okay, next, do we have Ms. Gilbert?
Hello.
Okay, next case on the agenda is RPC 3501503A on South East Street. Ms. Gilbert, you can start with your 8 minutes and tell us about this property.
Thank you. So the subject property was assessed at $144,589,900. And then at the first level, we received a reduction down to $143,087,700. The property was constructed in 2018, is comprised of 301 units, and it's mostly a mix of 1 and 2 bedroom units. If you turn to page 86 of the board's memo, that is where the start of my packet is. And if you turn to page 89, you'll see I have a 3-year income and expense summary. The property has consistently achieved NOI of averaging approximately $7.6 million. NOI in 2024 is slightly higher, $7.7 million. The difference is, if you look on page 90 of our packet, I have a comparison of the county's analysis versus the taxpayers' analysis. And there's really only a couple of differences. We are very close on the potential rental income. If you notice, I'm using potential rental income of $10,381,818. In my side-by-side analysis, the county is using $10,735,200. But the difference there is really because I'm picking up parking income in the other income versus the county is picking up the parking income in the potential rental income that I'm showing there. So really the rental income that we're showing is very, very similar. I'm showing total rental income, which includes apartment rent and other income of $10,681,818 versus the department, or excuse me, $11,618,000 versus the $35,200. So we're very, very close on our income, and we're also very close, if you notice, on our expenses. Very small difference there between $2,979,000 versus department's $3 million. So really, the only difference is the concessions and the vacancy. And I know that Arlington guidelines call for a 5% vacancy. However, the owner's marketing strategy is to include concessions. So if you turn back again to the 3-year income and expense summary, you'll see from 22 through 24, there's consistently reported concessions between 3% and 5% at the property. So again, this is a marketing strategy for them. So in my analysis, I took a deduction for concessions because otherwise we're overstating the gross potential rental income that this property can achieve. If the property was going to achieve only a 5% loss for vacancy and concessions, then they would need to report or advertise a lower gross potential rent. So again, since we're looking at the actual gross potential rent that they're reporting, I have taken that concessions to reflect what they can expect to achieve in rental income. I've also adjusted the vacancy up to 6%. And again, this is based on what has historically been reported. So in 2022, vacancy loss was approximately 7%, 6% in 2023, and 6.6% in 2024. As of the date of value, the rent roll was showing a vacancy of 6%. So those are really the two differences between our analyses. And factoring in the concessions and the vacancy results in an NOI of $7,660,300, which is again slightly above that 3-year average the properties reported. So that's how we get to our total value of $136,523,400. Thank you.
Okay, thank you. Mr. Cheekins for the county, please.
Yes, ma'am. So again, relying heavily upon the summary sheet on page 3, we can look at the income history, income stream last 4 years. Essentially, they were still working on lease up in 2021. As Ms. Gilbert's noted, obviously that's been somewhat stable the last 4 years, hovering around 9% or so. You can still see, regardless of that, growth year over year over year. Gross potential increased almost 6% in 2022, 4% in 23, another 3.5% in 24. Our projection for the revision in columns F1, F2 is actually negative 1%. That's because, again, we are held by the 5% guideline for vacancy and concessions. So we squash our potential gross to get to a stabilized effective gross that is in line with the history of the property. When we rely upon the effective gross income, and you're looking again 22 through 24, we see growth of 8.3%, 3.4%, 4.2%. Again, our projection is very modest at 3.1% year over year, well below what's been achieved the last 3 years. In regards to operating expenses, we actually grew the operating expense projection by almost 3%. Again, keeping in line with what's been achieved the last 3 years. As they achieve stabilization, we realize some of those numbers are going to level out. We, in fact, projected ours with a 3% growth. Again, NOI, 6% growth in 2022, stabilized, just slightly flat in 23, and again, almost 4.4% growth in 2024. Our projection is a full 1% less than that. Very modest, 3.3%. When looking at last year's assessment, this calls for a 1.1% increase over 2024's assessment. The appellants are asking for a negative 3.5% decrease. That's not seemingly in touch with what's going on with the income stream the last 3 years, especially the growth at the property. That being said, we do believe the county should be confirmed at the revised value of $143,087,700. Thank you.
Okay, thank you both. Questions from board members? No? Okay, any final comments, Mr. Chikas?
No, ma'am.
Okay, Ms. Gilbert, if you have anything else, you have a minute to wrap up.
Okay, thank you. Again, I think it's just important to consider the concessions in this particular case. It's not something that was done to stabilize the property or lease up the property. It's just a matter of their operating. Even if we look at the potential income and if we grow that 3.5% from the previous year for the apartment rent, and we still applied 3.5% concession, 6% vacancy, we're still going to come in with an NOI less than what the county is currently using at approximately 7.9 million, or a value of 140,752,900. So I do believe that the county's NOI increase is a little bit optimistic, and would ask the board to please consider the concessions and vacancy in this case, since it's part of how the owner operates the property. Thank you.
Okay, thank you both. All right, it's just among the board. Where's everybody? Mr. Hoffman.
I mean, the thing that jumps out to me on this building is just the, $475,000 a unit. You probably couldn't build this building for $575,000 a unit today. So it's in there significantly under replacement cost. It's stabilized, it's cash flowing. It really just kind of comes down to the cap rate. And so, I'm kind of inclined to go with the county here. We're pretty close. I don't think I see any holes in the county's assessment that are glaring as far as technical factors or actual, numbers that we could argue. It's just an opinion on cap rate.
Right, I would agree, but I also think that it didn't go down from 2024. So.
Yeah. I mean, they've kind of weathered the storm. There's still a lot of construction going on over there, but as far as return to the office and Amazon employees coming back down the street, and I mean, it's got some good things going for it. I mean, I think she mentioned 3.5% rent growth, but I think the county's looking at more like 4 to 6 on some of these prime multifamily properties. There was a lot of competition last year with Crystal City large apartments being delivered and absorbing, but they're all now pretty much full up. So I think the future looks good to this building.
Okay, anybody else have a different opinion or? All right. Somebody like to make a motion?
All right, I'll motion to confirm the reduced assessment from the county at 143,087,700.
Okay, and Mr. Mendez, we have a second. All in favor? Aye, opposed? Okay, it's unanimous. The county's reduced number of 143,087,700 has been confirmed. Thank you both. Okay, now we have Mr. Harmon
Morning.
and Mr. Chikas. Okay, so next case up is RPC 150600011. We're going to do something a little out of the ordinary. We're going to start with the county, and you can tell us about what you came up with in agreement with the appellant. Mr. Chikas.
Yes, Madam Chairwoman. So primarily, it's the idea of this property is a little unusual for a hotel in that it has a commercial tenant. The gist of it is that I double dipped on that available income for that tenant, in that I included it in a line item for income attributable to tenants as well as miscellaneous income. Upon realizing that for prep for today's case, I reached out to the agency representing the owner, Mr. Harmon. I expressed our regret that this was caught so late in the game, but wanted to offer him a revised value of $55,855,800. Again, 55,855,800. And this was accepted, I believe. I won't put words in Mr. Harmon's mouth, but I believe this was accepted by the owner.
Okay, thank you. Mr. Harmon?
Yes, Madam Chairwoman, members of the board, good morning. Welcome back. Glad to see most of you all back. See a couple not here, but Mr. Chikas's explanation of this property is accurate. We did receive an initial reduction from the county. And then yesterday, Mr. Chikas, when he was reviewing it, did find that additional income that he then took out. With this revised value, we've had time to review it. Ownership approves of this revised value at the previously mentioned $55,855,800, and we don't have any further argument on that. Thank you.
Okay. Any questions from board members? Okay, I assume neither of you have any additional comments to make. All right, then we certainly don't want to double count numbers here. So I'll move to accept the revised 55,855,800. Do I have a second? Mr. Hoffman, all in favor?
Aye.
Aye, opposed? None. So it is confirmed at the reduced number from the county's recommendation of 55,855,800.
So it would be a reduction, right?
Yes, reduction.
Yeah,
Thank you.
For the county's reduction, yeah.
Right.
But a reduction nonetheless. Okay, thank you. So next up, we have Mr. Warren. Can you turn your camera on or? There we go. Okay, the last case on the agenda is RPC 36016004, 1800 Ritchie Highway. Mr. Warren, you can start with your 8 minutes and tell us about this property. Can you turn your microphone on? I can't hear you.
Hello?
Okay.
Okay, sorry about that.
All right. That's
Sorry,
right.
we just switched computers yesterday, and I'm glad we didn't have this yesterday because.
Okay, hold on one second. Rosa, just reset the clock to give Mr. Warren his full 8 minutes.
Yes, ma'am.
Go ahead, sir.
Okay, thank you all very much. If you have our evidence package, or I guess I'm referring to the BOE memo that was sent out, a response memo by the county, I'll be starting on page 39 of 74, which is our summary of facts for this property. The subject property is the Westin Crystal City, located at 1800 Jefferson Davis Highway. It is comprised of one tax parcel or ID It's currently assessed at $73,844,000. The value we're asking for from the board today is a value of $60,511,000. The property was originally built in 1984. It's a full-service hotel, 220 total rooms. The hotel has one dining option, the Nutrio restaurant and bar. The property also has a fitness studio, outdoor swimming pool, and 16,000 square feet of meeting space. I'd like to direct the board's attention to page 5 of 74, which is the county's hotel INE summary page, which shows the last 4 years of operating history at the subject property. You'll see that in our pro forma and our requested income analysis can be found on column F. And right beside that on column E is the most recent year of annual operating profit and loss statement at the subject property. The actual total revenue that we're using is actually quite a bit higher than what the county is using in their current analysis, of $17,236,184 compared to the county's $16,595,000. However, the county in their 2025 income analysis is significantly underestimating the actual operating expenses that were reported in 2024. Their operating expenses used is 59% of total revenue, or $9,791,247. That's in comparison to the total expenses at the subject property of $10,579,110, which is 61% of total revenue. Now the county was applying a 4.8% replacement reserve, which was applied to all full service hotels in the county. The appellant in their pro forma also used that same 4.8% reserve rate, which again was applied uniformly in the county's analysis for all full service hotels for the 2025 reassessment. Now, as indicated in column E, the actual replacement reserves that were reported were 4%, and the resulting NOI, the actual NOI reported at the subject property of $5,967,626 is approximately $39,885 less than the NOI that's being estimated by the county in their 2025 assessment analysis of $6,007,511. So when you get down to the bottom line, we're actually fairly close in terms of total estimated revenue. The main difference here is with regard to the cap rate. The cap rate that's currently being applied to the subject property is 8.043%. That's fully loaded. So if you extract the tax rate out of that, they're using a 6.842% base cap rate full service hotel in National Landing, Crystal City. There are no sales really to support that value. There are no market data or information cap rate surveys that would support a cap rate that low. And as you'll see, and I'll discuss here, is no other neighboring jurisdiction is using cap rates anywhere near that low for full service hotels for the 2025 reassessments. The PwC fourth quarter 2024 full service cap rate, base cap rate is 8.5% for national properties. RERC fourth quarter 2024 full service for first tier investment properties in the Eastern region, that's 8.5%. That's a base cap rate as well. They indicated a cap rate for first tier investment properties, hotel investment properties in Washington, D.C. of 8.3%. Again, significantly higher than the 6.842% that's being applied by the county. When you look at neighboring jurisdictions, what are similar taxing jurisdictions applying to similar properties? Fairfax County is applying an average cap rate for full service hotels for 2025 of 8.8%. That's the average. Based on effective age, what they would be applying for this hotel would be 8.1% base cap rate. Washington, D.C., the CBD, they are currently applying 10.39% fully loaded cap rates to all full service hotels in their tax year 2026 assessments, which Again, when you extract the tax rate, that comes to an 8.5% unloaded or base rate. Again, you're seeing a pattern that all these cap rates are very similarly aligned when you're reviewing the market data from cap rate investor surveys from fourth quarter 2024, as well as what some of these neighboring jurisdictions are applying to full service cap rates. Loudoun County are using a base cap rate of 8.84% for all full service hotels. Alexandria are applying an 8.25 to 8.5 base percent cap rate to all full service hotels. When you look at the history of the cap rates that have been applied to the subject property and for hotels in general at the county, back in 2020, and this is before COVID and the lockdown, the hotel market was trending downwards. Occupancies, ADR, RevPARs were all trending downward at that time, and they were applying a fully loaded 8.04% cap rate to all properties in their 2020 reassessments. Now, following COVID, they bumped that up 50 basis points to 8.543 for 2021, and that stayed in place for the next 3 years, 2021, 2022, 2023. They kept that elevated rate for recognition of really how hard hit the hospitality market was from COVID. Now, dating back to last year, that started to come down, recognizing that these properties are starting to stabilize. Last year, it was an 8.293%, and now we're back to, again, 8.043%. So basically, back to the 2020 market pre-COVID. However, dating back then and looking at sales and market data at that time, we argued that cap rates were way too low at that time as well, and given the downward trend of the hospitality market at that time. So again, based off of again, market data and investor cap rate surveys, there are no indications that if you look at the county's guidelines for the 2025 guidelines for hotels, it indicates one sale of a limited service hotel in the county in 2024. There's one sale of a full service hotel in the National Landing dating back to 2023, and that's it. So I think your best indication of what cap rates should be would be based off of market data in some of these investor cap rate surveys and neighboring taxing jurisdictions, and no one is applying cap rates to full service hotels anywhere close to 6.842%. Thank you.
Okay, thank you. Mr. Cheekins, for the county, please.
Yes, ma'am. Let's start with the summary sheet to look at the return to normalcy. I believe, I won't put words in his mouth, but I believe Mr. Warren misspoke when he talked about the death knell of the industry in 2020. Outside of COVID, the industry had its best 2 years in 2018 and 2019, achieving historic metrics for occupancy, average daily rate, and revenue per available room. The county bested itself in 2019 after achieving those records in 2018. Obviously, COVID changed everything. The hospitality industry is essentially was almost wiped off the face of the earth. We knew that this would take a 3 or 4 year return to normalcy, and we see that essentially displayed on our summary sheet. One can see when looking at the projections made without the knowledge of the 2024 year, column E, the county underprojected revenues by over $500,000, $640,000. We did underproject operating expenses, but again, because we so wildly underprojected the income stream, we were only $40,000 away from the NOI that was achieved. I'd say that's fairly spot on, within 0.7% of what was achieved for the year. If one were to look at the years 23 and 24, the most stabilized, considering the Rupture's 4-year history, one can see that our projection again is spot on. We do believe that that is realistic and in touch with what's going on with the income stream. In regards to our cap rates, I'm going to ask Ms. Kelly to display the sheet that we showed our board members in regards to the institutional surveys that we have available to us prior to the data valuation. What we did see there was Mr. Warren spoke of fourth quarter metrics. Again, as we've talked about time and time again, We don't have availability to those surveys that come out after the date evaluation. So while we do look upon institutional surveys and agree that that gives us our best information points, we do need to rely upon those that are available at the time of evaluation. When looking at PwC third quarter national full service, one can see that the range is actually 6% to 10.5% with an average of 8.65. One thing we'll highlight, of course, is the sheet that you see on the second page, which is the success of Arlington's market. It cannot be understated how well Arlington's hotels did. They bested all other neighboring jurisdictions. They bested the state of Virginia as a whole and the DC metro market. When one looks at this, one can see that the average occupancy was 73%. Up from 71% in 2023. Average daily rate was at 195, up from 187. Revenue per available room was up 141, up from 132. Occupancy was 10% higher than the rest of the state of Virginia, almost 5% higher than DC, 7% higher than Alexandria, 4% higher than Fairfax, and even higher than Dulles with all of its airport travel. Average daily rate was almost $62 higher than the rest of the state of Virginia, almost $10 higher than DC Metro, $37 higher than Alexandria, $34 higher than Fairfax Tysons, and almost $64 higher than Dulles Metro. Arlington's revenue per available room, the same thing. The idea here is that we do believe that due to the success of the hospitality in Arlington, again, leading the state of Virginia in the metropolitan area, you look at the other anecdotal evidence. National Airport had passenger receipts that broke records in 2023 and again in 2024. There's more people coming to our area. More people are staying in Arlington's hotels. We do believe that warrants the idea that our range would be on the lower end. That being said, we do believe we have support for our cap rates through the success of the hospitality in Arlington County. We see that success essentially embolized by the income stream that was seen in 2022, 2023, and again in 2024. We do believe that our initial projection of less than 1%, within 1% of the NOI that was achieved is reasonable. And we do believe that the county should be confirmed at a value of $73,844,000. Thank you.
Okay, thank you both. Questions from board members? Mr. Hoffman.
Yeah. Blake, do you have anything on like, we don't have a lot of sales obviously in the county, but like other Weston sales, even if it's outside of Arlington County? Because I know that's a pretty desirable flag. Are there any comps, in the last couple of years that would reflect the market?
I'll be honest, we did not run a national comp search of Weston sales, just given history in Virginia boards wanting more comparable comps that are within the region or locale. So right. I don't have that specific information.
Do you know anything about the DC? There was a Weston DC that sold like in February. It closed.
I saw that, but we had looked at it in CoStar. There was no given cap rate that I could find.
Okay. Well, the article I got says it was a 7.5 cap.
Okay.
On 2024.
And again, I think our main point was, as you stated, there are limited number of comps in the entire area, not just limited to Arlington, but the entire DC metro area. And if you're limited in the terms of actual comps, you can derive actual cap rate data or information from, then we would say you would have to more closely rely on some of these national or local cap rate investor surveys for cap rate indications, and not just saying, well, here are the publications, but our market did really well. So even with no sales, we're just going to use a cap rate that's 165 basis points lower than what these surveys are indicating the cap rates are.
Okay. Yeah, I think I just, if you want to, you're probably going to argue a bunch of these cases going forward this year. I'll carry more weight to like this flag here's some trades based on the Weston brand or the Rosewood brand or whatever it may be, versus like, there's a lot of noise when you take those apartment studies because it's like this one became townhouses. This one got torn down and turned into a Wawa, right? Like all that, all those national surveys, it's just a very wide range. But you can generally say if something's got a Weston flag attached to it, it's got a very like kind of rigid standard. That's all.
Okay. Other questions? No? Okay, Mr. Chikas, if you take a minute to wrap up then.
Yes, ma'am. So again, if we look upon the income streams, we believe that the numbers support themselves. Again, our projections were very tight with what's been achieved historically. If we're looking in primarily this argument of on cap rates, I think we've demonstrated that the Arlington market is superior to the state of Virginia and the DC metro as a whole. If there's an inference that because there's a lack of sales, that must mean that cap rates aren't steady, one could easily argue the opposite, that those who are hotel owners are keeping them because they are achieving profit levels year over year. That being said, we do believe the county should be confirmed at 73,844,000. Thank you.
Okay, thank you. Mr. Warren, if you take a minute to wrap up, sir.
Thank you. So again, as Chris previously stated, and I previously stated as well, the actual income projection is not really in question here. We're pretty well aligned, I think. Again, it comes down to the cap rate. Our package, in addition to the RARC fourth quarter national survey markets for the Eastern region, it also includes the local region as well, the Washington D.C. market, which would tend to indicate a higher performance metric for a local market, and that indicates a base cap rate of 8.3%, down 2 or 20 basis points from 8.5%, which is the national market. So again, I think it's hard to apply a cap rate that's, again, 165 basis points lower than cap rates that are being applied to full service hotels in DC, and everything that the national markets and investor cap rate surveys are indicating, just based off of how well you think that the county's hotels are doing. With lack of sales, I think you have to rely a little bit more on that market data and those cap rate surveys, and that seems to be something that the other counties and jurisdictions in this area are doing, and all of them are pretty well aligned in the hotel cap rates that they're applying here. DC, Loudoun, Fairfax, Alexandria, all of them are significantly higher when applying base cap rates to their hotel valuations. And with that, I'll close it out. Thank you.
Okay, thank you both. Okay, it's just among the board. Mr. Hoffman.
I mean, the other thing that I noticed in this package is the STAR report on page 61 is very promising as far as hotel recovery. I think the ADR percent change from 2023 to the 12-month trailing into December 24 was like 6.1%. So they're charging 6.1% more for a room night on average than the previous year. So I mean, it starts to support, a more positive outlook in the hotel industry in Arlington. Now, is that all election year? I didn't hear that argument. I know sometimes inauguration years are big for the hotel markets here. So, I mean, we'll see in the future if that data is just a spike or if it's a long-term trend. But, my point on the hotel flag, since this is my first hotel case this year, if you're going to come in and just make a cap rate argument, I would go with a more kind of refined data set, because it looks to me like you're ignoring like the best comp because it's inconvenient because the cap rate's lower than the argument you're making. So, if you went in and you said, here's 3 Westons that sold nationally in major markets and they're all higher than what the county's, I'd carry a lot of weight to that. And then the other factor is always, is there a CapEx? Like, is there a PIP? Do you need to spend $10 million next year to keep the flag? you know, those are like major factors that would determine sale price. And so I didn't hear anything like that. So just to have to assume that the building's in great shape, it's got a long-term flag. It's kind of like a premier property, which I think would support the county's cap rate. So I'm done. I just wanted to be more thorough on the first hotel case because I feel like we're going to hear the same cap rate argument over and over. And if it's just nationally, we're looking at this data range from PwC, it's just going to be a waste of time.
Okay. All right, other folks? Mr. Mendez.
Yeah, I'd just like to kind of piggyback off what Greg said. I mean, it's really tough for me to sit here and try to make a decision on a cap rate in 8 minutes based on varying different things. I mean, I'm sure there's a ton of research and work that goes into that specifically. I know that we've made adjustments in cap rates in very rare circumstances if a property is really in trouble or distressed in some way, but this property doesn't seem to be either of those. And looking back, the highest it's ever been was back in 2018. It was around 71 million. And, you know, we're past that now, but I think that really just echoes the whole return to the office, recovery from COVID. And I think the future looks good for this property. So I'm okay with the county's assessment.
And it sold for 83 million that year too, Donnie.
I didn't see that.
Yeah.
Okay, anybody else? Anything different?
No, I agree with pretty much everything that Mr. Hoffman said, and I appreciate your input, Greg. I think that's really what we needed to kind of pinpoint, which is great. Thank you.
Okay. Would somebody like to make a motion then?
All right.
Mr. Hoffman?
I'll motion to confirm the county at 73,844,000.
Okay, I'll second. All in favor?
Aye.
Aye, opposed. Okay, it's unanimous. The county is confirmed at 73,844,000 even. Thank you both.
Thank you, board members. Thank you, Mr. Warren.
Thank you all. Yep. Have a good day.
Okay, that completes the agenda for today. The only other thing I want to go over, we've had several withdrawals and cancels. So just to make sure everybody's got this correct moving forward, for tomorrow's meeting, the first two cases, number 80 and number 38, have asked to withdraw. And next Tuesday, June 17th, the first case, BOE number 64, has also asked to withdraw. So I just want to make sure that you're aware of that. So as you're prepping, you take that into consideration. Does anybody else have anything else?
Mary,
Yeah, Mr. Hoffman.
is it possible? Can I be remote tomorrow, or does that screw things up?
No, we have enough of a quorum. I'll make a note of that. Yeah.
Okay, yeah. It just otherwise I'd have to miss like the first case. I can catch them all if I'm on the computer.
Okay. All right. No problem.
All right.
All right. Anything else? Okay, then we will stand adjourned here at 9:53. Reconvene tomorrow morning, June 11th, 9 a.m. It is in person for the board members. We will see you in the morning.
All right.
Thank you.
Thanks.
Thank you.